You're watching Retirement Talk with Eric Kearney, Southwest Florida's #1 show for smart retirement planning. He's a best-selling author, radio personality, and a fiduciary advisor you can trust. Get ready for expert insights, straight talk, and strategies to secure your future. Now, here's Southwest Florida's premier investment advisor, Eric Kearney.
Welcome to Retirement Talk with Eric Kearney. My name is Cynthia DeFazio, joined today by Eric Kearney and Joseph Lanza of Retirement Wealth Advisors. And to our viewers at home, as always, thank you for welcoming us into your home each and every week. We know that you're tuning in for solid financial guidance when it comes to the retirement years. Well, today's show is very special. We're going to talk about why do some people settle for good enough retirement planning advice. Stay with us. It's going to be a great episode today, I promise. Eric, how are you today?
Great, Cynthia. Thanks for having me.
Oh, well, thank you for having me. It's your show. I'm honored to be with you today. Joseph, how are you?
Doing awesome. Glad to be here.
So glad to be with both of you. It's always such a great time in the audience, if you will, in the studio, because we have so much fun. The audience resonates with that, and you're giving such amazing advice to our viewers at home. So, Eric, let me ask you, when it comes to good enough planning, a lot of people tend to settle for that, but why do they settle for good enough, especially in their retirement years?
This drives me crazy, and this is where our entire team really gets involved with our clients' lives like no other before. So what's happening is that we always talk about this deep psychological shift that happens. So in our working years, we're contributing, we have structure, we have people that we work with, we have goals, we have objectives, we have a sense of purpose, and we have identity. And then all of a sudden, when we get into retirement, there's some people that retire to something, and then there's just simply people that retire. So with this big psychological shift, what we're aware of with our clients is paying attention to their social, mental capacity and making sure that they're ready for retirement.
Yes.
Because what happens is that there actually are stages of retirement that we go through. These retirement stages are, first, we have purpose. We're at work and we feel like we're contributing. And then all of a sudden we go into comfort. I'm going into retirement. But then what happens if we're not properly prepared, we actually go into withdrawal. And then after withdrawal becomes good enough. That's not a good place to be. And so what we're trying to do is we're trying to reinvigorate people and say, okay, let's find you a new sense of purpose. Let's find you some new energy. We actually have to have something to do. So maybe working out, walking, joining with a trainer, maybe volunteering, finding something to do, finding another sense of purpose. Maybe it's friends, family, travel. Maybe it's reconnecting with old friends, but you have to have something to retire to. And that's really one of the biggest struggles. And when it comes to financial planning, a lot of people are so tired of the stock market. They're so tired of volatility. They're so tired of inflation that they're just like, you know what? This is good enough. Hopefully this is going to last me for the next 25 to 30 years.
The scary thing is you just said hopefully. So that's a scary thing. But let's talk a little bit, if we could, please, about comfort turning into complacency. Do you see that happening?
Yeah, so complacency is a very dangerous place to be. You know, we have this thing called financial no man's land. And when you get complacent, you end up in that financial no man's land. And it's not a good place to be. So the one thing that I want to talk about complacency is years ago, I coached soccer. And it had a lot of surprises when I went in there. I thought I was just going to coach a bunch of kids. And when I showed up, I realized that these kids were fast. They could dribble, they could run, they liked structure. And so we started coaching them. One of the things that I learned is that we had set time frames for practice. It was 6 to 7:30. And so while we were practicing, when I was there, I was their mentor. I was their coach. I was not their friend. And we were there to win. And a lot of times we would be walking off the field at 7:30 and all the other teams have already gone home at 7 and 7:15. But for me, practice was 6 to 7:30. That's when practice was. So rules were rules. And so what happened was when we started playing games, we won the first game and one of the moms came up to me and she says, "Great win, coach." And I said, "Oh, thanks. What was the score?" And she says 3-2. The funny thing is, Cynthia, this went on game after game after game. And so on the fourth game, she comes up to me and she says, "Great win, coach." And I said, "Oh, thanks." And I said, "What was the score?" And she says, "It was 4-2. And she says, "Let me ask you something. You really don't keep track of the score or if you're winning or not, do you?" And I simply said to her, kind of like as a matter of fact way, "Why would I play the game any differently if I knew I was winning?" And I never thought about that until I got home that night. And I was literally walking in the door and I was like, why did I say that to her? But it's because it was the truth, right?
Right.
And in retirement, even if you have a huge pile of money and you're 64, 65 years old, why are we going to become complacent? Why aren't we going to continue to win? Because again, we are not retiring into a single year. We are retiring into decades of retirement that's only going to get more costly. So complacency in a financial no man's land is a very dangerous place to be, and complacency has no place for your money.
Most definitely. And now I'm looking at you and I'm thinking soccer coach and I'm thinking Will Ferrell and the cappuccino machine. That's where my mind is going right
Kicking
now.
and screaming, right? Yeah,
Yes. I love that. Well, Joseph, let me ask you, what risks get ignored when things seem fine? What risks are often overlooked?
You know, some of those biggest risks in retirement are the ones that don't necessarily arrive dramatically or that you even feel every year. And when the market is doing well, be honest, people stop asking hard questions, and that comfort does turn into complacency. And two of the biggest areas we see this with are taxes and inflation. You don't necessarily feel inflation every year until you're in the supermarket and you check the price of ground beef and it slaps you in the face, right? You're just shocked by that. Or when you've been a cash investor too conservative for too long and you actually start to feel that purchasing power start to decrease over time. And taxes can be quite the time bomb as well. You know, we're often told, use tax-deferred accounts like 401ks and IRAs to save for retirement. Focus on accumulation and max those out as much as you can. But a lot of people overlook the fact that in retirement, when we go to pull money out of those later on, it's going to be all taxable income. And so this is why we want to do financial planning first. We want to identify what are any of these possible risks that maybe I'm not feeling today, but I'm going to feel in the future. And we can implement strategies now to combat those before they turn into bigger issues.
Thank you, Joseph. And Eric, why doesn't average planning work for real lives? Average planning.
Yeah. I mean, if we live in Florida or we live in the Carolinas, we're not living a normal life, right? We are living a very active lifestyle.
Yes.
I mean, it's like when people come in, I mean, you cannot believe the goals and objectives that we're handed. So we are living much more dynamic lifestyles, and an average financial plan is not going to suit you. So literally, we are looking at three aspects. So number one, we want to spend time with family, friends. We want to travel. We want to live our life. We want to upgrade our boat. We want to upgrade our car. And we are realizing that this stuff is getting to be more expensive. The biggest thing is we don't want a threat to our lifestyle.
Right.
And that's the biggest thing. People come in and they're like, look, I don't care what you guys do, but this is my lifestyle. And if you're going to manage my money, I want that. Well, on top of that comes market volatility, market swings, pullbacks, recessions, geopolitical risk. So then all of a sudden you have all these economic indicators that we actually have to deal with. And then thirdly becomes in the proactive adaptive planning. This is what is supposed to take care of all those economic problems and also support your lifestyle. So when people have a proactive adaptive plan, what it's doing is it's kind of heating off any problems that are coming on down the road, but then it's also adapting to the situations around you. And this is what people love about our financial planning is that constantly adapting to a situation, to a problem, and actually trying to correct it the best way that we can. So again, there's no problem with their lifestyle. So it really does make a difference between active planning, average planning, and dynamic planning.
Thank you, Eric, and thank you, Joseph. To our viewers at home, it's time for you to have dynamic planning in your retirement years. Well, how do you get that? We're so glad you asked. You can pick up and call the number on your screen, 1-800-779-1942. What you're calling in for today could be just an introductory talk for 10 minutes. Just let Eric and the team get to know you one-on-one. What are your goals? What are your dreams? And what are your hopes for retirement? If you'd like to take it one step further, you can actually book the complimentary consultation. These are your retirement years, and think about that for just a moment. You've worked your entire life to get there. You don't deserve good enough. You deserve exceptional. Take advantage today, 1-800-779-1942, or click the QR code at the bottom corner of your screen. We'll be right back momentarily. Don't go anywhere.
Hey everyone, welcome in. I'm Joseph Lanza with Retirement Wealth Advisors, and today I'm joined again with Donna Crone, our certified financial planner. You know, Donna, today what I want to talk about is there's so many few people out there that even have a financial plan to begin with, but there's also this huge disconnect between people understanding how does my investment management coincide with my financial plan? How do those two really work together throughout time? That's what I want to talk about today.
You know, Joseph, what a lot of people don't realize, or when they think of financial planning, they think investment management only. But in fact, that's just one portion of the entire financial plan. But it is a very important aspect of the plan because there's a lot of factors that come into play in terms of the decisions that are made around portfolio management, portfolio construction, as they relate to the financial plan. Let me give you an example. Let's say a client retires and we go through a market downturn, we go through a recession, something of that nature. So through no fault of their own, they have this pile of money that a portion of it has now gone away. How do we manage that? They still need their income. They still have the same needs. That hasn't changed, but the assets available have. So how do we manage that? And it's called sequence of returns. So the financial plan gives us an idea of what, how does this impact the plan over time, which is very, very crucial. And it allows us to now go back to the investment management side and say, okay, what strategies can we employ to get them through this as smoothly as possible so that we can, further along in the plan, see a positive result?
Right, and that's where you heading up the financial planning department is really going to work with Eric and myself on the wealth management side throughout the year with that client, with their situation. You're building those scenarios. You're showing them, here's what happens if the market does this. Here's what happens if the investments do this. That way that client is never left guessing or losing sleep at night. It really gives them that comfort factor, if you will.
I would agree. And I think it's a great marriage of two disciplines within the financial services world that come together and really complement each other and really produce a very positive result for the clients that we work with.
Absolutely. There's so many different aspects here with financial planning. You have taxation, you have estate planning, transfers of generational wealth, sequence of returns risk like Donna was talking about, and that investment management piece. Donna, thanks so much for joining me today. Back to you guys in the studio.
Welcome back to Retirement Talk with Eric Kearney. My name is Cynthia DeFazio, joined today by Eric Kearney and Joseph Lanza of Retirement Wealth Advisors. And we're talking all about why good enough planning is not good enough for your retirement lifestyle, for your retirement years. Joseph, I want to ask you a question. What problems tend to sneak up on comfortable retirees?
Yeah, just like what I was saying before, a lot of those biggest threats don't necessarily arrive dramatically, but this is the exact reason why we do financial planning. We're not just looking at, can you retire? We're saying, can you stay retired? And we're looking at all the different financial aspects that affects your life. Taxes, inflation, healthcare, long-term care, estate planning, your investments, the associated risks with your investments. And I think one of the biggest benefits of working with a true financial planner is you get an objective viewpoint on not just your current situation, but your future one. And what I love about this, it allows me to then show my clients, not just tell them, but show them, hey, here's what a possible long-term care event looks like and how we're going to be able to pay for that. Or here's what your future tax liability looks like. Here's some different risk or strategies that we can implement to mitigate that tax risk. Because retirement is not just a one-time decision. It's something that you have to continuously work at. And when all of those financial aspects of your life are not properly coordinated, that's when you can have a lot of those smaller risks turning into much bigger ones down the road.
Makes perfect sense. And I'm so glad that you brought up long-term care, if you will, because Eric, I want to ask you, talk a little bit about how health or family can change a plan overall. Can it guide it in a different direction if you're not expecting it?
Yeah, so one of the oldest sayings is you have 33 problems until you have healthcare as a problem, and then you only have one. And a lot of times, healthcare doesn't seem urgent, right? Market swings, inflation, how am I going to pay for meatloaf this week, right? I mean, everything is so right here and now. And then all of a sudden, when we have a health scare, now all of a sudden we have to worry about the financial aspect of it, also the mental and the emotional part of it. So anytime that there's a health scare in the family, it does change the dynamics of the entire financial plan. And again, we put off healthcare planning and long-term planning way too long. And Fidelity updates their study every single year. It's going to cost the average American couple $250,000 to $300,000 before healthcare, way before long-term care is even a problem.
Wow.
So we have to keep addressing all of these different issues. And the one thing about retirement wealth advisors is we are factoring in all of these different problems, whether you care about them right now or not. So even when inflation was not an issue, we were thinking about it. Even when you had required minimum distributions, we were thinking about it. Even if we thought that there was going to be a financial hurdle that was going to come along, we already thought about it. So these are the things about being proactive and adaptive in a financial plan that a lot of people don't have. People don't like financial hurdles. And so again, the financial planning, when you embrace it and you bring it into your life and you actually accept it, it kind of keeps you on the same track so that you don't get derailed when a health I want to say
issue
health
happens,
scare,
yeah.
health scare.
Yeah.
We knew where you were going with that,
Yeah.
which is why we're a good team here.
Yeah, you guys knew what I was saying.
I got your back.
Totally
man.
knew
It's
where
okay.
you're going with that. So I have to ask you, what helps to separate a decent plan from a resilient one, Eric? We've talked about all the different scenarios, and I'm sure the viewers at home are wondering this as well. Decent versus resilient.
Yeah, so when we have a very successful client, what they really like is resiliency, right? And people are always looking for perfection. What you're really looking for is resiliency. So when you build a plan that is proactive and resilient, it is the difference between an assumption and adaptability. Because really, we don't want assumptions. I don't want to be able to adapt to a situation. And when you build a financial plan, the one thing about our marketing and our financial planning is it's actually factoring in 1,000 different scenarios. And so we can think of scenarios that you can't even come up with. And so when we write the financial plan, this is not based on a financial plan. It is on your financial life and your lifestyle, your healthcare, your anticipated longevity, your rate of inflation. And everybody does have a little bit different of inflation in their life. Some people like to sit around their house and they're more of a homebody. Somebody else wants to travel the world. So they're going to have different lifestyles, and that financial plan, again, has to surround you with really what you want to do. So again, you want to build resiliency in there, especially when it comes to your income.
And I will say, I have never met somebody that said, I'm okay with a decent plan.
Yeah.
Right?
Right.
Like, how many people are saying, it's good enough?
Yeah,
Yeah.
it's so-so, but I'm going to keep it.
Nobody wants to be
Yeah.
average. Nobody
Yeah.
wants a cookie cutter plan in their situation. And I think today more than ever, just from what I've seen with people coming in the office from a lot of big box national firms, is they use that word. They're like, I know I'm getting cookie cutter service right
Yes,
now.
yes.
And there's so many people that are graduating from their advisors' capabilities. Their portfolios have gotten to a certain point where they're like, maybe even, I never thought I would have this much money, but now it's starting to expose that maybe I didn't have the right advisor for that money, because
Right.
there's a
Yes.
lot more sophistication that I need that my advisor's not necessarily bringing to the table. Because it is alarming when, say, you sell a business and you put money into the portfolio and everything stays the same. It's like, well, I just had this huge influx of assets and my plan is staying exactly the same, and there's
Right.
no new strategies or sophistication coming to the table. Maybe that advisor doesn't have those tools at their leisure to use.
And what's so interesting is that you're bringing that up, Joseph, because a lot of times people get stuck working with someone who specializes in the accumulation phase of life. And it's so easy to feel like you're doing a great job, especially when the market is performing well. But getting into the distribution years, that's your wheelhouse. That's where you come to life. And you design these plans that customize someone's situation just for them. So that is the difference. And I'm so glad that you brought that up. And Eric, I know that you and Joseph have a very special offer to our viewers at home, a message, if you will. Spend some time talking about that, please.
Yeah, so Cynthia, we feel like a lot of people are overwhelmed with their finances and retirement. So today, if you feel like you're out there in a financial no man's land, or you are looking for a strong second opinion, go to myincomeplan.com and download your very own retirement income guide. You'll actually have this today. And then what we'll do is nicely reach out to you and see if you want to set up a 10-minute phone call, or if you actually want a real strategy, we'll put together a personal financial blueprint for you that is yours to keep. Give us a call today. We look forward to seeing you soon.
Eric, thank you so much. Joseph, thank you so much. To our viewers at home, as you can see, good enough, quite honestly, is not good enough. Not for you, not for your situation. Call in today, 1-800-779-1942. As Eric mentioned, this could just be a discovery call of 10 minutes. or you could book the complimentary consultation. Taking it one step further, click the QR code at the bottom corner of your screen. That is the fast track to get on the schedule of Retirement Wealth Advisors. We're going to take a very short commercial break. When we come back, we're going to talk more about how good enough is not good enough for your retirement years. Stay tuned.
What does your retirement look like? Is it filled with travel, spending time with family, or are you too worried to even think about your hopes and dreams? Eric and his team can answer your questions with a complimentary review of your retirement and income plan, and it all starts with getting to know you. Because every dream needs a plan. Call Eric today and schedule your visit. You only retire once, so let's get it right the first time.
What I enjoy most about retirement planning is sitting down with you and having real conversations about your retirement dreams and goals. We specialize in helping people just like you prepare for the retirement they've always dreamed of.
Retirement Wealth Advisors with Eric Kearney.
Welcome back to Retirement Talk with Eric Kearney. My name is Cynthia DeFazio, joined today by Eric Kearney and Joseph Lanza of Retirement Wealth Advisors. And we're talking about average good enough is not good enough for your retirement plan. So gentlemen, before we jump into the next question I have for Joseph, can we talk about how cute my cup is? I mean, viewers at home, can you see this cup? This is so adorable. I'm in love with it. It is the cutest thing I've ever seen. Farm Truck Financial Podcast. Talk a little bit about this and the specialness behind this cup.
Yeah, so that is our new podcast, and we're super excited because I think people are overwhelmed by the financial industry, right? And they're actually frustrated by the financial industry. You know, they're just like, I'm tired of buying products, tools, and investments, and it's like, I have more questions than answers. And so what we're trying to do is on the podcast is really try to slow things down a little bit and make it easier to understand and really try to help out more people. And that's really it. And so I've enjoyed doing the show. And I mean, I'm just having a really good time with it. I mean, after a long time, it's like, I love doing this. So I'm super excited about it.
Yes, and I'm super excited that you're now in Greensboro, North Carolina. I mean, you're getting closer and closer to home. So thank you for that. And I love the truck. It's just so cute. Joseph, I want to ask you a very important question. When do people usually realize that good enough wasn't enough if they were just getting by? Talk about that.
I think a big problem that people face is when they wait too long to take action, a lot of times their options are dwindling and they're not realizing that in real time. But I'll give you an example of this. Say somebody has a large IRA account and they didn't really focus on those Roth conversions. They wait too long, their ideal window maybe closes. They get to that RMD age of required minimum distributions and they realize, man, I got to take out a lot of money out of this IRA account. It's a big taxable event. Maybe I should start focusing on Roth conversions right now. It's too late for that. Now you have to satisfy your RMD first before you can actually convert the rest of that money. It's something that we should have been thinking about years previously. Or even take somebody who didn't focus on financial planning or income planning very much. They just decided, I feel like I have enough money, so I pull the trigger on retirement. The scary part is the first 5 to 10 years of that retirement, they could be perfectly fine.
Right.
But after that 10-year mark, they might realize with taxes, healthcare, inflation, we need a lot more money than we ever thought we did. But what do we do now? Do we go back to work? I mean, the question that I always have for people is, don't we all want to know what these possible situations are going to look like so we could do something about them now?
Yes.
Even the possible loss of a spouse and the changes that that brings, right? Tax brackets changing, income brackets changing. We want to be making sure that that's a scenario that we're factoring into or modeling with the financial plan. And what we're essentially doing is saying, let's be proactive about us finding any of these possible weaknesses before actual stress exposes those weaknesses. Because it's not just about, does your plan work today? It's, does the plan work in the future under stress?
Is it difficult to course correct? I'm just thinking if you're on a road trip and you realize that you've made the wrong turn, you can actually correct that.
Right.
But what about when it comes to a financial plan for retirement? Can you course correct?
So I think that there's a lot of people, and we see this through the podcast or through the classes that we teach. There's a lot of people that say, Eric, I've been lackadaisical about my retirement. And this isn't through a lack of ambition. It's just I'm having a hard time making a decision on anything. And so the problem is that as we go further into retirement and we have to change financial direction, I think that the margin for error becomes smaller, our options become less, and it just makes decision making even harder. And so there's a lot of people that say, I know I have to make a decision. It's just difficult for me. So I think that you can change direction at any point, but there has to be verification. There's got to be proof. There's got to be evidence of, if you do change course, why this is actually a better direction for you.
And what is the upside of tightening a plan before there's a problem? Let's talk about that for a little bit. Tightening up the plan.
So I think updating, maintaining, monitoring, and managing a plan is a huge detail that is often missed for a lot of people. I think Joseph and I have seen a lot of people who come in the front door and they're like, here's my financial plan. It was written 5 years ago. I've never looked at it since. Our financial plans are written and updated on a regular basis because the world is changing, your lifestyle is changing, your rates of return are changing, inflation is changing on a regular basis. So we are always updating and tightening up that portfolio or that income plan or that financial plan based on your lifestyle. Because when all of a sudden the market swings come in and people are always worried about a recession, a lot of people are going back to their financial plan, they're going back to their income plan, and they're saying, look, I actually already factored this in. I'm actually going to be okay.
And I think that's where a lot of fear is rooted in. I don't mean to cut you off, Cynthia,
no,
but
I'm glad.
that's where a lot of fear is rooted in. When we don't understand what that situation looks like, if we've never stress tested against a market downturn, then when we start to see a little bit of red in the market and it's getting a little bit worse, that's why people make these irrational decisions.
Yes.
Because they don't have a financial plan to begin with that's telling them, hey, we already tested for this scenario.
Yes.
You know, we show clients in a bad timing scenario, if the market goes down 20% back-to-back years, your first 2 years of retirement, it's the worst time for it to happen. Are you still okay? Yes, great. We show them that example there. When somebody doesn't have that, even if they see a 5% decrease in the market in a short time frame, that can induce a lot of panic.
Sure. And when you think about it and look at it from that perspective, the two emotions that often drive us to make decisions, fear and greed. But if you have a comprehensive retirement plan, that helps give you peace of mind so that you don't emotionally react when something's going on.
Right.
Eric, only a couple minutes left, or actually just 44 seconds left of the show. Any final words of wisdom? I had wait.
You just have to remember that, look, it is the financial plan, it is the income plan that is the anchor to your lifestyle. So while a lot of people do worry about everything that's going on in the world, focus on your own personal financial situation through the financial plan, through your income plan, and use that as the anchor to your financial plan.
Eric and Joseph, thank you so much. To our viewers at home, thank you for spending time with us today on Retirement Talk with Eric Kearney. Be safe, be happy, be blessed. We look forward to seeing you back 1 week from today, and click on the QR code so you can get your complimentary written income plan. See you next week.
Hey, Southwest Florida, thank you so much for watching. If you have any questions after today's show, please give us a call.
Remember, you only retire once. Let's get it right the first time. Have a great week and an even better retirement.